What up, YouTube? It's your boy AJ back with another video. Today's video, we're gonna have a nerd talk about taxes. It may not affect some of you guys right now, but I know it's gonna affect you guys in the long run, especially when you have to pay taxes on capital gains. So we're gonna go through some of the Q&As from the IRS, and we're gonna go into some calculations, do some scenarios, and do a lot of different things to help you guys understand how taxes work. So let's get into it. So we're going to start with the IRS virtual currency guidance. As you see, you have the purpose. As you see, you have the purpose, the background, and the scope. We're not going to go in this too much in depth, but it's just basically providing a brief overview on capital gains and the tax brackets that you guys will be falling into. So next, we're going to go down to Q&As and look at some of the questions that people have asked the IRS and look at some of the high-level answers that the IRS has provided. So question one, I think it's a very important question. How is virtual currency treated for federal tax purposes? Federal tax purposes, virtual currency is treated as property. General tax principles applicable to property transactions apply to transactions using virtual currency. This is very important to annotate because a lot of people have misconceptions of crypto tax versus income tax. It clearly states right here that virtual currencies falls within the property tax rules, which means in property tax, you're buying, you're selling, you're trading an asset. You're either making money on it or you're losing money on it. Both are reportable. Same with cryptocurrency. You're buying, you're selling, you're trading an asset. Either you're making money or you're losing money. Both are reportable. Whereas with income tax, you just report what you made for that year with a W-2 or 1099. But as this video go on, I'm gonna walk you guys through the breakdown of the different tax rates based on how much you're making in crypto. So next, we're gonna go down to question 5. How is the fair market value of a cryptocurrency determined? For the U.S. tax purposes, transactions using virtual currencies must be reported in U.S. dollars. Therefore, taxpayers will be required to determine the fair market value of virtual currencies in U.S. dollars as of the date of payment or receipt. Very important. So I'm going to use Safuu as an example here. Let's just say you got in March 1st, you decided to take profits in May of 2022, and you took profits at an average price of $200. You cashed out on 200,000 Safuu. The fair market value at that time was $200 per Safuu token. All right, for your $200,000 grand total. Let's just say you continue to hold and that fair market value went down to, let's say, 20 bucks. You're only going to be taxed on the receipt of your initial withdrawal of that $200,000 at that fair market value rate of $200. So you have to be mindful of what you're doing when you're taking profits, if you want to take profits. And if you do decide to take profits, I have a strategy that I use when I'm taking profits to keep that value the same. And that's taking the money out and converting it to a stable coin, all for tax purposes, because I want to be able to maintain that value as long as possible until I actually see a shift in the market where I can actually match that, or I've accumulated enough rebases to say that I'm fine paying the taxes on this. You know what I'm saying? To put it in your bank account, because it doesn't matter until it hits your bank account as profits. You can take it out, you can cash it out, you can convert it, but as soon as it hits your bank account, then it's taxable income. I hope that makes sense. So we're going to read one more question, then we're going to go to something else. All right, so this is another really important question because of the blockchain that's coming up, and people are going to be mining / becoming validators. So we need to understand the tax rules behind mining and validating. So question 8, does a taxpayer who mine virtual currencies, for example, uses computer resources to validate Bitcoin transactions and maintain the public Bitcoin transaction ledger, realize gross income upon receipt of the virtual currency resulting from those activities? The answer is yes. when a taxpayer successfully mines virtual currency, the fair market value of the virtual currency as of the date of receipt is includable in gross income. All right, so it's always important to cover your bases. It's good to know where you fall within the tax structure, because if you're mining, you're not off the hook either. Everybody is subject to taxes. All right. So it's good to know this stuff before you end up getting caught up in, you got all this money out here, you haven't paid taxes on it. So now the IRS is coming for you for tax evasion, embezzlement, money laundering, and all of these other different charges that can be brought up against you. So it's good to know this information. I'm definitely gonna put this link in the description so you guys can look at it, formulate your plan on if you want to take short-term profits, you want to continue doing so, and just weigh the pros and cons. At the end of the day, it's your money. You do what you want to do with it. I'm just providing information, giving you guys something to look at and something to think about. So next, we're going to go to a breakdown rate chart of the taxes, which is going to identify the actual taxes itself, the status, whether you're single, married, or filing head of household, things of that nature. So let's get into that. As you see, this is the cryptocurrency tax rates for long-term gains for the 2021 tax year. As of now, I'm not sure if there's a 2022 proposal out there, but if there is, I'm gonna let you guys know in another video. But for now, we're gonna focus on the tax rate. As you see, the tax rate ranges from 0 to 20%. At the top, you see different statuses, which are single, married, filing joint, and head of household. If you filed a 1040 at any point in time, you will be familiar with these statuses. And below these statuses, you see different criteria of amounts. Going back to my example I used earlier, let's say we have a Safuu holder that bought into Safuu on March 1st, 2022, and decided to cash out in May 2022 at $200 a token for an ROI of $200,000. In this instance, this one falls under long-term capital gains, because what's classified as long-term capital gains is that you have to hold an asset for 365 days or more. In the case of this falls under short-term capital gains. Short-term capital gains are classified as an asset being bought, sold, or traded less than 365 days. So any point prior to 365 days are subject to short-term capital gain taxes. So let's go down to short-term capital gains and look at the tax rates for those. So we see now on short-term capital gains, the tax rates get a little bit more aggressive. So going back to my example about this single Safuu holder that cashed out on a $200,000 ROI, now we're going to look at the tax rate that they're expected to be taxed at the end of the year on capital gains. So $200,000, looking at the tax rate, that would be a 32% tax rate for capital gains, which is pretty steep. And the thing about the IRS is that they want to reward people for holding long-term assets. And for some assets, the longer you hold, the more money you make and the less taxes would affect you. Where in this case, you cash out on $200,000 and you're going to pay 32% in taxes on the back end at the end of the year. We're not even including the 16% sales tax that you already pay in the protocol. So like I said before, fair market value on the date that they cashed out on this, the fair market value is what they're going to be taxed, the $200,000 at the $200 per token price range. This wraps it up for this section. So I'm going to go into how the IRS knows if you're buying or selling crypto. For a lot of you that ask the question on how does the IRS know if I'm buying and selling crypto, this is it right here. I don't care if you have a MetaMask wallet. I don't care if you have a crypto.com wallet, Coinbase, Trust wallet. It doesn't matter. The moment that you create an account, you've already KYC'd yourself by submitting high-level documentation to say you are who you are and that you want to establish a crypto account. Because you already provided your social security number, similar to what you do with the IRS. You already provided a copy of your driver's license or passport, and the IRS they're a federal entity, so they have access to all this information. At the end of the year, they have to submit a 1099. And on top of that, these exchanges are constantly working with the federal government. They're working with the SEC, the IRS all the time to figure out better ways of tracking who's buying and selling crypto. There's really no way around it unless you plan on leaving the country with pending tax evasion charges, but it's not worth it at the end of the day, especially if you have family you establish here and you plan on coming back and forth to the country. It's not worth it. But it's not my job to tell you what to do and what not to do. I'm just here to provide you information and provide some of the people that was curious about taxes an overview on what they need to be considering. So next, we're going to go through some forms that need to be filed when claiming capital gains on your income tax return. Schedule D, Form 1040, capital gains and losses. Very important. You must file this whenever you're buying, trading, or seeing realized gains. So realized gains, to reiterate, is gains that you've taken profit on and actually put it in your bank account. Putting it into a stable coin is still unrealized. I do it all the time because I want to be able to maintain the value once I cash out. But once it hits your bank account, it's realized gains at that point. So once you do that, you have to file this form. You may be required to file an additional form as well, which I'm going to get to right now. So we have Form 8949, sales and other dispositions of capital assets. All right, so for most people in crypto, you're going to be required to file both of them because you're buying, you're selling, you're doing things like that. And the other one is case by case. It's a lot of different scenarios that will require you to file the Schedule D 1040. But at the end of the day, the IRS want to see you filing these forms, making sure that you're holding yourself accountable and that you're making note of all your transactions. We know that the blockchain kind of does it for us, but the most important thing is fair market value. Because if you're claiming that you sold a token at 14 bucks when you really sold it at 200 bucks and you made a lot more money, they're going to look at that. So it's very important to know fair market value in which you took profit at. Like I said before, data receipt and realized gains is once it hits your bank account. All right. If it's still on the blockchain in a wallet, that's fine. You haven't taken profit on that. It's unrealized still because anything can happen on that blockchain. God forbid you get hacked, but I'm just stating the obvious. Anything can happen. All right, guys. So I hope you guys enjoyed the video. I just really want to give you guys a high level overview on how taxes work since I've been getting a lot of inquiries about it. But please like, comment, subscribe. Holla at your boy. I'm out. Peace.